Welcome to the Mortgage Brothers Podcast. I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. We're going to bring to you today the conversation about down payments. That's right. And
what does a down payment mean? You don't think about it. You talk about down payments every day, but what is a down payment actually when you peel the layers of the onion back at its core? What is a down payment?
Yeah. All right. So I don't know, were you asking me that question, Tom?
I was just asking the audience that question.
Oh, okay.
Yeah. But why don't you, I think it was interesting before we started our podcast, we kind of had a little bit of retrospect. Why don't you just give the audience a little bit of retrospect as to what has changed from, 20 years ago, 30 years ago to today in terms of getting loans approved overall?
Yeah. Okay. So now we're talking about down payments, but down payments today, like how we source them, like why does a bank ask you to document where they're coming from? Are they coming from your own savings? Are they coming from a gift? Are you borrowing the money? Where are you borrowing it from? If you are, all this goes back to someone would say the old days, the savings and loan days. And back in the savings and loans, when banks actually had relationships with borrowers, they had an entirely different way to document down payments. And they had a different way to document everything, your income, your assets.
Yeah, actually had different ways to document getting the loan approved, period.
Yeah, they didn't have credit reports back in the day. I think in the 80s, it was just starting to come out with bureaus or anything, that was credit report related. So I think what we've wanted to, I think what we're talking about is that down payments showed the strength of a borrower and the commitment that the borrower had. And the commitment was the commitment to pay that loan back for the bank, right? For the institution. And
you mean it's a down payment? It's not like a security deposit where if something happens, the bank gets the house back and keeps a security deposit.
Right.
It's not really like
that,
is it?
It sure isn't. And I think that's right. We have all sorts of questions when it comes to down payments. And how did I do, answering that question as far as, you were asking about the retrospect?
Well, yeah, I think, what you're talking about is, how loans actually got approved. It was relationship based.
Mm-hmm.
And we didn't have all these clicking and side clicking and uploading and side loading and the credit reports, but you went into a credit committee room and basically said, this loan, I believe, is going to get paid back. We have commitment from him because of certain things. One of them was relationship based.
That's right. That's right. So loan officers, they would go into their room with the presidents of the bank, and they would actually give all the reasons why we should give Farmer Joe or Sally the loan. And they would actually have to kind of convince the committee that this was a good investment for the bank. And it was all relationships. Well, mostly relationships.
Mm-hmm. So all of a sudden, the relationship society kind of goes away. We become much more digital. We become much more leveraged. Money's being loaned. I don't know how many more hundreds of thousands of multipliers more today, but now we need to come up with a bigger, faster way to be able to know whether or not someone's going to repay or live up to their loan obligation. How do you do that?
That's right. Technology has changed everything, right? And that's what you're getting at. I mean, we're no longer in those days where you can save money in your mattress. You cannot save money in your mattress. And I know there's still people out there, right? They call us and say, yeah, I have 20 grand in cash.
Mm-hmm.
I mean, there's fewer people today that actually have that money saved in cash, but there's still people out there who didn't get the memo. right?
Yeah, yeah, and we get calls I get calls at least twice a week where someone has money in a lockbox, has it under their bed, and unfortunately, in today's non-relationship day and age, we can't take people's word for it. And one of the things that we're going to touch on here in a few
Right.
minutes is how important, where the down payment comes from. In the olden days, if Farmer John showed up and said, you know what, I've got $20,000, sitting in an old hay barrel that I had, you'd say, great, that's awesome that you were able to save it. Today, no way. You can't take their word for it.
Exactly. And in the old days, of lending and the savings and loan, it was very common that 20% was the minimum. They didn't touch anything unless there was at least 20% equity, where they had, the borrower had skin in the game of 20% or more. And because of our technology and the ability to have these credit reports and all this data that analyzes risk, they can now pinpoint the borrowers that they can give money to with an acceptable risk with as little as 3% down. So for some borrowers, they still want a lot. Some borrowers will only get approved if they do put 20% down, if they, in some cases. But again, technology has allowed us to expand funding to so many more people. And so the 3% down payments are now what we see, for a lot of first-time home buyers come up with. And, a lot of times we'll have borrowers say, well, I'm bringing 50% down payment. Why aren't you going to treat me different than the person who puts 3% down? And I don't know if you want to comment on that, or because, I think that there's something to be said that there is a big difference between, obviously there's a big monetary difference between the down payment of, 50% down and 3% down.
Right, right. Well, I think just to make a comment on that is, if we say down payment, equals commitment, all we're looking for is the level of commitment the borrower is going to have to repay its obligation. So if you're telling me that he has 50% down payment, I'd say that, he's got, 15 times, more commitment potentially than the person with 3% down. Now, what that ends up begging is, okay, where did that 50% come from?
Yeah.
So that's when we kind of look, historically and say, well, we can no longer take the word, even though you and I personally, the Mortgage Brothers team, would love to take the word of our borrowers, but Fannie and Freddie Mac won't let us just document, oh, we believe them. They make us source. So all the underwriters source and put their detective hat on, and they say, okay, what level of down payment do they have? That's the what. The down payment is really a commitment. Now it's, where is it from? That's the big piece.
That's right.
What and where?
Okay. So let's just address that. I mean, it doesn't matter how much money you have down, and that's where it doesn't matter if it's 50% or 90%. You are going to have to document where you got the money.
So you're telling me that if I put 99% down and I need a 1% loan, they're still going to care where that money came from?
Absolutely. And
so that just tells you, if a bank is not willing to give you a 1% loan, they're really not only in it for just the money. They're really looking at it from more of, will they fulfill this 1% loan obligation over the next 30 years, period.
Yes. And, we were talking about this, from time to time. Well, obviously there's low risk. And I know that a lot of frustration that borrowers will have is, why do I have to document where my big old down payment comes from? I mean, gosh, I could buy this thing with cash, or I have all this money. Why does the bank care? We agree that there's lower risk. And I think that's the whole point. Like, when there is large down payments, we agree that there's low risk, but the bank is not in this business to own real estate. They don't want to chase your your payments either, right? They don't want to, they want to know that you're a committed person, that money came from you, that your savings. It's how you came up with that money. Again, because
yeah, so you're saying if you buy a $300,000 house and you're only asking for a $3,000 loan, you're saying the bank wouldn't do that all day long? Wouldn't they want to own a house? where they, potentially have, 99% equity? And the answer is no. They're not in the business to own real estate. They flat out don't want real estate.
Yeah, that's correct. They just don't want real estate. Now, this example is an extreme, your example and the one I use these are extreme examples, but the whole point is they don't want your dang home. You know,
They just want you to repay the loan. That's it.
they just want your payments. They don't want your loan. They don't care how much equity there is. Now they do care, but it's as long as they have documented where it came from.
That's right. And when we look at this, it really is not the olden day relationship people, because they would take that loan and probably hope that you don't pay.
Right.
They would probably glue your mailbox door shut just so you couldn't make your payment. But today, because our loans are sold to Fannie Mae and Freddie Mac, they're the ones that are buying these loans, and they don't want to own real estate. So you really have to dig back. And this is why we thought this was a semi cerebral podcast that we had, because when you really think about it, a down payment is a lot more than what meets the brain when you first hear about it, because you're just thinking security deposit. You're just thinking, oh, I have skin in the game. Yes, it is skin in the game, but it really represents your commitment. And the second biggest thing is the where. So I don't know if we've touched on that enough, Ed, but if you want to go through and just, a lot of our first-time home buyers do have money sometimes sitting in a lockbox or under a mattress, or they need help from family members. So let's talk about where down payments can be acceptable.
Okay. So down payments are acceptable when they come from your own checking and savings accounts. Okay. So from the funds that are deposited in there are coming from your payroll, right? From your employer. If they come from, a tax refund or some type of asset that was deposited in there that we can source, they cannot be borrowed in most cases.
What about Buddy Johnny, who gives me a $10,000 check, slaps me on the back and says, hey, you can pay me back later?
Yeah, I think I had one of those situations a couple weeks ago where a borrower had an old Buddy John. What did you say, Buddy Johnny?
Buddy Johnny.
Buddy Johnny. Yeah, there's no go on that. What we have to do is if you've already deposited Buddy Johnny's, gift to you, or that loan, was it a loan?
Yeah, the borrower says that it's a gift, but it really is a secret loan.
Yeah. So what we do is we don't count that. We actually just deduct that from your account. If we see it on your statement, we're going to get rid of that thing. We're not going to use Buddy Johnny's loan or his supposed gift to you. Now, we will accept gifts from relatives. It has to be a relative, at least some type of, we can at least tie that this is a relative giving you money. So that brings in gifts are acceptable sources, your own money that you've saved. Now, I will say this too. If there is unsourced funds, it's okay. We consider it yours when it's seasoned in your accounts for 60 days.
So are you saying that if Buddy Johnny gave me a check 6 months ago and I deposited it, would that be okay?
That money is now considered your money and it's seasoned, and there's no problem with that.
Okay. Now, what does it matter between a gift between a family member and a gift from Johnny? Who cares? It's a gift. They both love the borrower. What does Fannie and Freddie Mac care?
Right. Borrowers will ask, why does, who cares where I get the money from, right? Well, it goes right back to our conversation initially. It does matter where the money, how it's documented, where it comes from, because studies will show that the reason why the banks want you to receive a gift from a relative is because you're going to have a higher probability that you will pay your loan on time, because someone you love and know gave you that money because they worked hard. They worked hard for that money, and you're likely going to be committed to them just like as though it was your own funds.
Mm-hmm.
So whereas Buddy Johnny gives you the loan, you're just going to have less of a commitment to pay back Buddy Johnny than if your sister, your brother, your aunt, your uncle, your mom or dad.
You mean you might not be friends with Johnny forever?
Might not be friends with Johnny.
That's right, forever. but you're likely to show up to your family Thanksgiving for the next 60 years.
Right. You'll never hear the end of it.
That's right. That's right. So there is a big difference between getting a gift from a friend and getting a gift from a family member. The friend gift is not permittable.
Yep.
So
banks know that the banks know that your relatives are going to keep you accountable.
That's right.
Yeah.
That's right. Okay. Something else that I thought is very interesting, and this is further proof as to why a down payment is not just simply a security item, enhanced collateral, whatever you'd call it. On a primary home, the minimum down payment is 5%. Why is it 25% on a multifamily unit? Why is it only 15% on a single family investment property? Well, because borrowers are more likely to walk to not fulfill their obligation on an investment property. So all they do is they're tweaking the down payment in order to increase that level of commitment because they know through historical tracking, borrowers will more easily leave an investment property. So again, in the Great Recession, when property values went upside down and homes were worth 50 to 60% less, a 25% down payment on a multifamily wouldn't protect the lender or bring them whole 100%, but it sure gave them a good idea as to your level of commitment, that if you had at least 25% down, that you were very committed to that investment versus the primary home only at 5%. So
Yes.
something I just think is very interesting.
Yes, that's right. And let's just add one more thing to, down payments, as far as where they can come from. If you can borrow the money from something that you own, like as long as there's collateral. So you can get a car loan, you can get a boat loan. If you have a house, a second home, primary home, you can get an equity line on it as long as that loan is collateral. It has collateral. The bank will let you borrow money for your down payment.
So what's the difference between borrowing money from a friend on your down payment versus borrowing money on a boat that you own?
Right. Okay. So again, I think the whole item there is the bank still has collateral. They don't want to own your boat.
Right. Also they know that you probably worked 6 months to be able to buy that boat, and you have your own money sitting in that boat. So that's the key thing, is the fact that you're getting a loan on your boat. It's because it's loan free at that time. And if you choose to put a loan on it, it was still your money to begin with. And you're simply extracting that versus going out and getting a personal loan from your banker, brand new from scratch. Personal loan, non-securitized, that's truly borrowed money, and a down payment cannot be borrowed unless it was originally your money to begin with, that you're putting a loan on.
Right.
Okay. What else were we saying that would be important? We talked about VA. Anything big on VA, FHA that we think the listeners would like to hear?
So VA and FHA only lend on primary residences, and no matter what kind of loan you get, a conventional or FHA or VA, you're going to be able to get gifts. And the entire down payment can be a gift when you use a primary residence. Now, conventional financing is the only avenue that will lend on a second home or an investment property. And there is a rule the banks have that say on a second home, they want the minimum down payment on a second home is 10%. They want at least 5% of the down payment, 5% to come from your own funds. So it's interesting. The banks they want 10% total, but they want 5% of the down payment to come from your own funds. And then on investment properties, there's no gifts allowed. So again, on a second homes, you can get a gift, but a limited.
Okay. All right, good. What else did we not cover?
I think IRA distributions and 401ks are the last things we wanted to talk about. But people usually have these retirement accounts. And again, there's different retirement accounts in the school districts, like 403Bs, very similar to 401ks, where you can take a loan against, and that was, we missed that. You can borrow, but you can borrow it against it's very easy to borrow against a 401k or a 403B or anything equivalent to that.
Mm-hmm. Because it's already your money.
Yeah. And the banks are entirely fine with that. In fact, we don't even count the loan payment against you. That's not counted in your debt ratios. Also, you can take an IRA distribution for your down payment. Depending on your age and your tax situation, you will have either an early penalty, withdrawal penalty. But maybe there are some cases when you're a first-time home buyer that you do not. So something that you want to consult with a tax advisor about. But I think overall, I think anything else we've missed? I think we've.
Yeah, no, I think so. Just to recap, again, the most important thing is, the what it represents. It's simply commitment. And it does obviously have to do with security and making sure the borrower does, or the lender gets his money back eventually. But the lenders don't want the house. They want commitment from you. So that's number one. And then number two, the where. It has to ultimately always be tied back to you. And even if in the case of a gift from a family member, that family member is basically an extension of who you are. Therefore, that's commitment from you in the eyes of Fannie and Freddie.
Okay. I like it.
Awesome.
I think it's time to go home.
Let's call it a day.
All right. Everyone, have a great week.
Take care, guys.
Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to Tom at azmortgagebrothers.com or yours truly at Eddie@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC, does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.